What is a loan estimate? When should you receive it and what should you be looking out for? Hi, guys. Jeff Sheeman. I'm a local mortgage lender currently licensed in Missouri and Florida. If you're in the market to purchase or refinance, my team and I would love to help you. Please reach out 417 844 9047 or click any of the links in the comments below. Let's get into it. Hey guys, welcome back. All right, so we're going to get into loan estimates today, how to read them and what they look like. So that way, whenever you're talking with your lender or in your future home buying process, you've at least seen this once before and at least know where to come for questions. Obviously, if you're using me, this is my process on how I do it. If you're using another lender, I'd encourage you to have a conversation with them and have them explain this to you. If you can't have that conversation with them, maybe that's red flag number one, and you should come over to me and let me and my team help you. Okay. But in any case, let's get into it. So I have up here a conventional loan estimate. This is, and you can tell that by up here in the right corner. Okay. So conventional loan estimate. I'm going to click on a different one here. This one is an FHA loan estimate, and I need to zoom in a little bit on that. This next one is going to be, see, it says other RHS. That's a USDA loan estimate, what they look like. And then this last one is a VA. Okay. So that's how you can tell what type of loan estimate that you're looking at. I'm going to go back to the conventional and I'm going to go through the whole conventional loan estimate. A lot of this stuff should be the same across the different loan types, but some of the stuff's different, whether there's funding fees or not, or whatnot. And so I'm going to get into that. So as you can tell, the lender's name is going to be up here at the top. That's whether it's me or anybody else. I always emphasize that these are loan estimates. These numbers can and will change. I do a really good job, or my team does a really good job of getting estimates for all of the fees on these estimates. And so they're usually pretty close, but they're not set in stone yet. And so don't be surprised if they change a little bit. Okay. So the date issued will be whatever date we issue it. The applicant name is, this is Johnny Borrower. We're going to use him in several examples here, from Anywhere, Missouri, 65807. And his new house, the new place that he's buying, is 456 New Home Boulevard. Very creative, I know. All right. So the sale price on this house was $235,500. It's a 30-year loan. It's a purchase transaction, not a refinance. It's a fixed rate, not a variable rate. It's a conventional loan. And something that's really important here that I want to call your attention to is the rate lock. Was it locked? Yes or no? You will get a lot of reasons why we're locking and not locking rates. I will give you reasons why we're not locking and locking rates. I want to caution you that anytime you get maybe some big online lender that is calling you and saying, hey, I can give you a better rate and this is how I'm going to do it and blah, 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 you should always ask them for a locked loan estimate. A very common trick in this industry is to send out an unlocked loan estimate and show you too good to be true numbers. And I actually just did an interview with a borrower. It's getting edited right now, of a situation where a local bank did just that. They sent him an unlocked loan estimate with too good to be true numbers. Then they sent him a locked loan estimate with too good to be true numbers. He and I discussed it, and he ended up switching to the other lender only to find out that they couldn't actually honor it. Bait and switch is a real thing in this industry. So if you have questions, please reach out to me. Okay. Whether I'm helping you or not, or if you're with somebody else. Okay. So we're at back to the sales price of $235,500. Our loan amount is $188,400. So what does that signify? That signifies this borrower's down payment. So we say $235,500 and we subtract out the $188,400. So this borrower is putting down $47,100. We're going to divide that number by $235,500, the purchase price, and that is exactly 20%. So this borrower is putting down 20%. So you'll notice that there's not going to be a charge for mortgage insurance. On conventional loans, it's called PMI, private mortgage insurance. And if you have less than 20% equity in the home, you have to pay it. Okay. It falls off at 78%, or we can have it removed at 20 or at 80% loan to value. So that's the opposite. When we say you have 20% equity, that means you have an 80% loan to value, or a 22% equity is a 78% loan to value. Okay. All right. So we're at 188,400 loan amount. We're at 6.375. The principal and interest are $1,175.37. So there's usually 4 to 6 components of a monthly payment. It's principal, interest, taxes, and then insurance and HOA dues. And I give you kind of asterisks on those. So principal and interest are this number, $1,175.37. Well, we also have to pay a 12th of homeowners insurance and a 12th of your real estate taxes. We also might need to pay mortgage insurance, and then we also might need to pay HOA dues. This particular loan, he's not paying mortgage insurance. That's the PMI I was talking about. But he does have to pay $323 in escrow. Escrow is just a fancy word for a bank account that the title has, and we deposit your 1/12 of your homeowner's insurance and 1/12 of your property taxes into that account for the year. And then at the end of the year, we make the payments for you to your insurance and taxes. But we have to collect that, and it's called escrow. So your principal and interest is 1175.37. Your escrow is 323, which makes your total all-in payment 1,498 on a loan estimate. This number will fluctuate a little bit. Okay. So then estimated taxes and insurance, this is telling you what your escrow account has in it. Does it have property taxes? Does it have homeowners insurance? Does it also have other with HOA dues? Maybe you have, $1,200 a year for HOA dues. So there's an additional $100 that we have to hold back. Okay. So that's so far so good. Estimated closing costs. A question that I commonly get asked is, what are your closing costs when people are shopping between lenders? Really, that's a good question, yes. But closing costs really should be uniform amongst all lenders. And I'll get into that a little bit in a second. The only thing that really should be different is Section A, the origination charges. But again, there's some other tricks that lenders do on this to make their loan estimates look better than somebody else's. And I'll show you what those are too. So this guy, his estimated cash to close was $53,891. So that's going to be the down payment plus the closing costs is what he's bringing to the table. So 54 grand. All right. So Section A, or the second page of these loan estimates, is really what's important. This is where all the line items and fees get put in here. So top page, right? Interest rate, loan amount, closing costs, cash to close, things like that. Those matter, but here's all the line items of everything. So Section A is origination charges. This is what you guys need to be paying attention to. Sometimes there's big lenders that I'm not going to say any names, but maybe they rhyme with pocket, or maybe they are on a front and they have an airline. Maybe they tailor to some more military minded individuals. So there's some big online lenders that this is the section that you need to analyze with a fine tooth comb. And honestly, you should analyze all of them, and we should be able to explain our fees and all of this. Okay. So currently we have a few different fees in here, and you will see different things in here, and they're called different things, but they're all the same. They might say a processing fee or an underwriting fee or whatever. And you can tell that actually on my estimates, I have both. Some people lump them together, whatever. You're going to see point something of loan amount points. This is what it costs to get the rate that you're at. Most lenders will have a number here, a small number, usually a couple of $100. Sometimes it's zero. Sometimes it's $15,000. This is when people are saying, I'm going to give you a 4.99% rate when we're in a 6% rate environment. I'm going to give you a 4.99 rate. This is what you check. This is where you're looking to see if, one, is the loan locked right here. And if it's not locked, it can still change, and the numbers can and will change, right? So you really want a locked loan estimate. And then you want to see as small of a number here as possible. But some of these big lenders, what they'll do is they'll automatically add in $2,000 or $3,000 or $4,000 here and buy your rate down for you. I'm going to do a separate video on what discount points are, whether they're permanent or temporary. I've done them in the past, but I need to clean it up and do another one. But basically what you're doing is you're paying for your interest rate here. Like I said, mine, there's usually $300, $400, $500, somewhere in that ballpark is what we get. I can go a lot higher, but there's obviously going to be a conversation there if we want to spend some money to buy the rate down. And then you have your processing fees, tax service, things like that. So at my company, we charge $9.95, plus there's an $85 tax service fee for a conventional loan like this. This borrower was $180 to get them to the I believe it's 6.375. Yeah. Look at Section A. That's the one that matters. Okay. The rest of this, you'll see if there's differences and big differences, then maybe we'll call our attention to it. So Section B is always going to be services you cannot shop for. This is stuff you have to have for the loan, right? An appraisal. We have to have an appraisal. We have to make sure that the house is worth the value that it is, the purchase price is. credit report, verification of employment. Sometimes we charge that, sometimes we don't. It really depends on your employer. Most lenders are similar to that. If we have to pay to receive that information, then we charge you, because sometimes your employers charge us and whatnot. But there's either a fee there. Sometimes it's half of this fee. Sometimes it's $60, but that's pretty common. These fees are all pretty uniform within this industry. $550 in my market's pretty good for appraisals. Sometimes on rural appraisals, we have to spend a couple extra $100 to get the appraisers to go out far. But usually somewhere in that $500 to $1,000 range is really where they're at. Section C, title fees. So when you guys make an offer, you and your realtor decide which title company you want to use. The title company charges me the same amount as it charges another lender the same amount. That's just their fee to do it. So Section C should never be different between any lenders because it's all title fees and it's the title company's charges. So as long as you're using the same title company, this fee should be the same. So I always look at C and H together. So C and H is titles insurance. And in this particular one, that's a very, very big number for title insurance. Usually title insurance is $100. This loan estimate wasn't accurate at the time of creating it, probably. But a lot of lenders, what we do is we lump these two together. We lump C and H together because those are technically both title fees. Sometimes they get broken up this way. Now we actually put all of it here and we only leave like $100 or $150 over here because that's actually what the closing disclosures come out looking like. Okay. So we've gone through section A, which is your origination. We've gone through section B is stuff you can't shop for. There will be some differences here a little bit between lenders, but shouldn't be much. Section C, there shouldn't be any differences. Section E, taxes and other government fees, $160. That changes based on the county that you're in on how much we have to pay to record this stuff, but they're all around there, $100 to $200. Usually people don't get excited about a $100 fee in a $260,000 transaction, but those are all going to be the same. Prepaids. This is homeowners insurance premium. You have to pay for 12 months of homeowners insurance at the day of closing. You're prepaying for the next year of homeowners insurance. On top of, after making that 12-month prepayment, you have to pay 1/12 of that number every month for the next 12 months. So you prepay for a year in advance, and then you have to pay 1/12 every month for 12 months. So that way, when we get to the end of the 12 months, we can pay for the next year in advance. Okay. Have to do that on all loans. The only time you don't have to do that would actually be in this guy's situation. If it's a conventional loan with more than 10% down, we can waive escrows. Most people don't waive escrows. And I would encourage you to probably not waive escrows unless you're very financially aware of your situation and budget really well. What I don't want to see happen is people say, I don't want to waive, or I want to waive escrows. I don't want to pay it every month. And then at the end of the year, now you owe for property taxes, you owe for your homeowner's insurance. It's Christmas time. There's just lots of things. So I would rather see people budget and just do this monthly just to help me sleep at night. And then you also have prepaid interest. So this is something that will change, but it doesn't change differences between lenders. We have to pay for interest from the day we close on the loan to the end of that month. So let's say in this case, I forget what day this was, but let's say it was October 26th. And so October has 31 days in the month. We have 5 days left in the month. You have to pay a per diem interest rate. So it's 33.36. This number is calculated from your interest rate and your loan amount. So it'll be different for everybody. But what's important is this number, the 5 days, because if we close towards the end of the month, that number in prepaid interest there is smaller, right? We have 5 days at $33 a month, so it's $170. Let's say it was 15 days. Now you're talking $500 ish, probably. And these are direct closing costs. So so you might say, Jeff, well, why wouldn't we all close at the end of the month? And we do a lot of times. Whenever sometimes maybe borrowers or sellers, maybe we're tight on cash for closing. That's usually my advice is let's close towards the end of the month to make this number cheaper. But it's actually a net neutral benefit. It doesn't help whether you close at the end of the month or the beginning of the month because it's all in relation to your first payment. So let's say you close October 25th and you have to pay 5 days of prepaid interest. Well, you don't have a mortgage payment for October. You don't have a mortgage payment for November, but your first payment's due in December. Okay. So from the day of closing, if we close October 25th till December is 36 or so days, right? You could also close October 15th and have 45 days until your first payment, but your prepaid interest is going to be elevated. It's going to be a little bit higher because you've moved into the house and we've closed on the loan earlier than we would otherwise. That's really confusing. There's a lot of people that get really confused understanding prepaid interest, but it's really a simple thing. The day we close till the end of that month, we have to pay for that interest. You skip a month, and then your first payment is due in the following month. Okay. And then your initial escrow payment, title and counties, we actually have to hold back extra reserves for this. Usually it's about 3 months for each. We already went over title insurance and how that's not a realistic number. And you'll see on some of my other ones that hopefully that those aren't as high as that. So then you add all of this stuff up, right? Comes to $6,791, and that's your total closing costs. Okay. We didn't finance anything in this, and you'll see some of the funding fees you'll get financed on the other ones. We have the $47,000 for the down payment from the borrower, which brings his cash to close at $53,891. Okay, and then your third page here is going to show just some more like my information, the company's information, your total interest percentage over the life of the loan, how much interest you're going to pay on this thing, and then also your APR. APR is really important. Total interest percentage, you probably don't want to look at that number. There will also be some important information here, and this is another important thing when you're looking at other lenders. There's a couple things here. Servicing, that's important, right? Do we intend to service your loan, or are we going to sell it? So there's really two things with these loans. A lot of lenders, big banks, everybody, we sell these loans as mortgage-backed securities. We sell them on the secondary market, right? At the lender that I'm currently at, Flat Branch, we have the option to retain servicing. And so that way we don't actually sell the servicing portion of the loan. And so you will always pay Flat Branch, and it always looks like you're paying Flat Branch. And then if you have any questions, you just call me. When we sell these loans, obviously I still want you to call me because I still want to be your mortgage guy, but my powers are limited after they get sold. And I do both. I also broker loans here at Flat Branch. We retain servicing, and then we also sell servicing. So we can do any of the options that we want, and whichever fits our situations the best. But just know that a lot of mortgage lenders don't intend to service, and they sell them as soon as they originate them. Late payments are important. Most mortgages, every mortgage that I've seen and had experience with, the payments due on the first of the month. It's not late until after the 15th, so that you have about a 2-week grace period there. Obviously, pay your bills on time and try and do it on the first. Okay, so this first loan estimate was a conventional loan estimate. I'm not going to go through every single thing on this. I'm just going to pick out a few of the important things that we talked about so you can kind of see the differences, and then you can rewatch this video if you need to. All right, so on this loan estimate, same information. The sale price is different. Johnny borrowers. This one, the rate was not locked, so pay attention to that. It's an FHA loan. And this stuff I'm not going to go through, the loan amount, interest rate. What's important is you go to the second page on an FHA loan, there's mortgage insurance premium. So on an FHA loan, there's an upfront mortgage insurance premium that you have to pay on top of monthly mortgage insurance. All right, the monthly mortgage insurance is $101 a month. On an FHA loan, the mortgage insurance, the monthly mortgage insurance is for the life of the loan. You never get rid of it. The only time you get rid of it is if you refinance the loan or sell the house and get a new mortgage. Okay. So on an FHA loan, there's a upfront mortgage insurance premium. A lot of times this is added to the loan amount. So you'll see right here, down here in calculating cash to close, closing costs financed. We just add that $38.82 to your loan amount. It increases the payment a little bit. I have had one borrower once that prepaid for it. They had some cash, or their mom had some cash and wanted to pay it for them and give them a gift to do it. But outside of that, monthly mortgage insurance is pretty important for an FHA loan. The rest of the fees should all be the same, whether it's title company, insurance, that kind of stuff. So then again, we're going to come down to cash to close. We add all of this page up, comes to $10,259. We're taking out $38.82. So the funding fee, or the mortgage insurance, it's technically considered a closing cost. It's just not money that you typically have to bring to the closing table because we finance it in. Okay. And then we have the down payment of $8,000. This borrower put $1,000 in of the earnest money deposit, and then they were also receiving $6,870 in seller credits or concessions. Basically, what seller concessions are, if you don't already know, is when the seller agrees to give you money towards this transaction. The way they do that is via seller concessions, and we are limited on different loan types to how much money we can ask for from the seller. So let's say it's a $100,000 house and you say, "Hey, Mr. Seller, I want to give you $100,000 for the house." And the seller says, "Okay." The seller receives $100,000. Let's pretend we don't have to pay realtors or anything else in this transaction. Okay. Well, now the second offer is, "Hey, Mr. Seller, I'll give you $100,000, but I need $5,000 in seller concessions." So then that seller is now receiving $95,000 because we're going to pay him 100, but he's going to immediately give us 5,000 that we can use for closing costs. And this is one of the ways that we get people that maybe don't have enough saved up for down payment and closing costs to get into homes. We'll have the seller pay for it. And so the next question there that begs is, well, why would the seller take $5,000 less? Depending on the market, that's just part of a negotiation. But there's also an option to increase the price. Maybe now we buy the property for $105,000 and give $5,000 in seller concessions. The trick with that, or one of the things to consider with that, is the appraisal. Now the house has to appraise for $5,000 more in this example. Okay, so that's something that you should look at. So this is an FHA loan. Big differences are that it says FHA right here. It's going to have a funding fee of a percentage of the loan amount. It's not the same for every loan. And then there's also monthly mortgage insurance on an FHA loan. Okay. But the same thing goes with this. Third page is your APR. And if we're going to service the loan, this one we intended to service the loan. Okay. Next one is going to be USDA. And you can see that in the beginning of the video. I told you it says other-RHS. This one is locked on a USDA loan. We're going to scroll down. There is mortgage insurance on a USDA loan. It's a little cheaper than an FHA, and this is also a lot cheaper property too. I think this house was $90,000, the other one was 200 and some. So that plays a part also. When we get down here, USDA has a guarantee fee, very similar to FHA's mortgage insurance, or their upfront mortgage insurance premium. The guarantee fee percentage is lower than the FHA percentage. So comparing those two together, USDA, for that particular situation on the funding fee, USDA is better, right? Because it has a cheaper funding fee and a cheaper monthly payment fee. That being said, USDA loans debt to income requirements are a little tight. I'll do a video on that later on what they are and why they're a little bit tighter to get approved for compared to like an FHA or conventional loan. Same thing, services you can't shop for. $550, $249, the guarantee fee. There's a technology fee, a USDA technology fee, $25. But the rest of this stuff, as you can tell, is the same. The underwriting fee was a little bit more on a USDA loan. And this one was actually really unique because it happened during the government shutdown. And so we had to sit on it for 45 days or so, which was interesting. But the rest of this is the same. You add all this up. If you're adding that funding fee to the loan amount, if there's any seller concessions, and if there's any adjustments or other credits. Sometimes sellers will give credits for property taxes, HOA fees, things like that. Since they have lived in the house for however many months, they owe the bill for those many months. But the bill doesn't usually come till the end of the year. So the seller will actually give you a credit on a lot of this at closing. So that way, whenever you pay the bill, because you pay for the full year, and then part of that money is from the seller. Again, we keep that in an escrow account for you typically. Okay, so that is a USDA, and then VA. VA, same thing. It's a VA loan here. This one was locked. We're going to scroll down. Funding fees. So this one decided to have a little bit of points. We decided to buy the rate down. Sometimes we have to buy the rate down to make the payment low enough to make your DTI work. Sometimes we do it just because we do the math on it and you decide you wanted a lower rate and we increase it. And again, that's where this number is reflected here. Okay. You'll notice that there's not a funding fee on the VA loan. VA loans can have a funding fee though. It's up to the particular veteran. If the veteran qualifies, if they're exempt from funding fees, then they don't have to pay a funding fee. If they're not exempt, they do have to pay it. And again, it's a percentage of the loan amount. And it's handled the same way as the rest of them are. You can finance it, pay it outright. 99% of the time, it seems like everyone finances it. Okay, so 4 different loan estimates here: conventional, This one was FHA, USDA, and VA. As always, if this prompts any questions, or hopefully it answers a lot of questions, and I've explained this, I know it's a really long video and I'll try to shorten it, but there's a lot of good information in here. Your lender should be explaining all this to you. They should go line by line if that's what you want. If you don't want, just like some of my clients don't want to do it, they just want me to send it to them so they can sign it, they check the payment and call it good. I'm happy to help with those too, but I want to educate you as much as you want to be educated. So please ask questions. Give me a call, 417-844-9047. Check out one of my websites. Homewardlending.com is a new website that's up and going. Don't be too critical of it. We just got it rolling. And then you can always go to my website for Flat Branch. There's some mortgage calculators and some other important information on there. Peek around in this YouTube channel, find some other videos. If you're in the mortgage process, there's lots of good content here. I am not a professional content creator. I'm just a mortgage dude trying to explain some of this stuff so that way you guys have it to watch it over and over again. These are probably one of the biggest transactions you guys have in your lives, and they're very emotional. They're very anxiety fueled transactions. And so I want to educate everybody and really just pull the curtain back and show everyone how this works and what's important to consider. I hope it wins me business, but I also hope that it arms you when you go to buy a house, whether it's with me or somebody else. Gives you the information so that way you know you're not being taken advantage of and you're getting the best deal for you and your family. I appreciate this follow. Give me a like, give me a thumbs up, give me a support, leave a comment, whatever engagement you can. Find me on Facebook, like me, leave comments on that stuff. I really appreciate it. And if you know anybody that's in the market to purchase or refinance, send them my way. Thanks, guys.